Everybody's got a different opinion, I guess, about how portfolios should look like at the moment. I think your typical, Aussie portfolio at the moment. Australians, we're very patriotic people, so we like holding our Woolworths, we like holding our CBAs, we like holding our BHPs. We've grown up holding those assets that we know and those companies that we've grown up with in this country. So I think the average Australian portfolio tends to be a little bit passive as opposed to how we think portfolios should be managed at the moment, particularly in this market. So you do have your sort of core Australian equities. Some Aussie investors will have some international exposure. I don't think I'd have any arguments against me at the moment when Australian investors tend to be very underweight international equities. We think Aussie investors should hold more international equities than they do Australian equities in terms of portfolio weightings, but you just don't see that because, again, we're patriotic and we love the names that we can see and touch down the street. In addition to that, you might have some blended fixed incomes and banking hybrids as well. They seem to be very popular in Australian investment markets. That's something we tend to stay clear of, but they seem to be quite popular for Australian investors. And also quite low cash holdings at the moment, and for obvious reasons. Cash is negative at the moment when you take into account inflation. How do we think about portfolios? We don't want to hold a lot of correlation with the market at the moment. So if we're holding equities, we're not holding equities in the traditional sense, where we're just owning BHP or CBA and hoping over time they go up. We're looking to own equities where a manager can be quite agnostic in terms of what sectors they want to hold. We want managers and we want investment specialists to be able to have very large cash positions. And we want investment managers sometimes have the ability to actually make money when the market falls. And if you can do that, actually make returns when the market falls, coming back to that the whole idea about performance, you're then compounding off a higher base. And so we're really looking for uncorrelated returns at the moment when structuring portfolios. Look, we did take the view that we wanted to reduce equity market exposure from circa 40% down to 20-25 towards the end of last year, October, November. Now, we didn't know about COVID then. So we took the view at the time that we're in the 10th year of a bull market. So since basically the GFC markets had just gone up for 10 years, bull markets tend to run out of steam after 6 to 7 years. So we just took a view that going forward, over the next 10 years, interest rates can't go much lower. Well, they have this year, but in reality, they can't go much lower. So what silver bullets did central banks have at the end of last year to really kickstart markets again if they had to? And that was, again, as I said, pre-COVID. So we were thinking about how to generate returns over the next 5 to 10 years is going to be very, very different to how we generated returns over the previous 5 to 10 years. And that was with the help of equity markets going up and central bank policy being very favourable to equity markets. So we took the prudent approach to reduce our equity exposure and then start thinking about some of these sort of more non-correlated market strategies, allocating to things such as precious metals, gold, silver. We were doing that in the middle of 2019, end of 2019, before everybody started talking about gold. So you need to prepare. You don't know when these themes are going to play out in the market, but it's important to prepare for when they do play out.